If you're near or in retirement right now, this stock market probably feels like a contradiction. On one hand, the headlines are great. The market's been pushed higher for several years, and mostly by a small group of huge tech and AI companies. On the other hand, valuations are stretched and people are whispering bubble. And you might be wondering, how many more years like this can we really have before something breaks? Now, when you're 35, this conversation, it's interesting. But when you are 50, approaching retirement, or maybe you're 60 or 70 and you're already in retirement, this conversation is terrifying. So in this video, I want to show you how we think about retirement income in this expensive AI-driven market and some strategies we take to address those concerns. Now, the real problem for retirees isn't just that the market might be overvalued. The real problem is what we call sequence of returns risk. That is, if there's a big drop in the market early in retirement and you're having to sell shares to fund your lifestyle, what happens is you lock in losses and permanently damage the life of your portfolio. So instead of asking, is this an AI bubble? The better question is, how can I structure my money so I still get paid if this market finally tanks? And our answer is simple. We use dividend investing as the primary engine of retirement income, and on occasion, we use fixed annuities as an option for those people who want an extra layer of guaranteed income. We start with income first, then we layer in growth second. Now, I want to plug in a framework that explains why we like dividends so much. Now, I've shared this information before, but it's worth bringing back and repeating because it completely changed how I think about dividends. Dividend investing, 3 ways to win, even when prices fall. Now, if you watch this video all the way to the end, you will understand dividend investing better than most advisors do. You'll also learn how dividends create income that you can plan on. And finally, you learn the 3 ways to win with dividends, even when prices are declining. Now, the theme of this video is really how dividends equal income that you can plan. And before I get too deep into the weeds, into the details, I should define what is a dividend. A dividend is money a company pays you simply for owning a piece of it. Now, one way you can think about it is, imagine that you own a lemonade stand with a bunch of your friends. And you're very successful, you sell all kinds of lemonade. Well, you got to pay for the lemons, you got to pay for the cups, you got to pay for the sugar, etc., etc. Now, of course, the money that's left over is the profit. And when you take that profit and share it among the partners, the owners, or the friends, that money that's shared is a dividend. Put another way, when it comes to companies and on the stock market, we have a company that has shares that you can buy. That company makes a profit. Then that company shares the profit. And that money that gets shared is a dividend. Another way to put it is if you own 3 shares in a company and that company declares that they're going to pay $1 per share in dividends, you will receive $3 of dividends simply by owning those 3 shares. Very easy and simple. Now, who pays dividends and why? It's really important to point out that not every company pays dividends. In fact, High growth companies, young companies that are still growing very quickly, they tend to take their profits and their cash and reinvest that money for further growth. And that's different than what mature companies do. Mature companies who have been around for quite some time and are profitable and create a bunch of cash, those are the companies that tend to pay dividends. And that's really it. Now let's talk about dividends versus stock price. The key point here is that a company that pays dividends, they're going to announce the dividend amount and when they're going to pay that amount in advance. The stock price can go up, the stock price can go down. The dividend amount and the dividend payment date does not change regardless of what the stock price does, period. Now the process goes something like this. You have the announcement date. This is when they tell us how much and when. We have the record date. And we have the ex-dividend date and the payment date. Now, the really important date to pay attention to is this ex-dividend date. Reason being, if you own the stock prior to the ex-dividend date, then you will receive that dividend. Now, why does this matter? What this does is it allows you to plan for this dividend income because the company tells you in advance how much they're going to pay and when they're going to pay it. Now, stock price, no one is ever going to tell you what the stock price is going to be in 3 months. They're never going to say that, because if they are, they're lying. And what this does is it changes your strategy from a hope and pray that the stock price is going to go up, to a plan and verify. A plan and verify strategy is going to give you confidence about the income that you're going to receive, and most likely it's going to help you sleep at night. In retirement, predictability matters. In fact, I would argue that in investing, predictability matters. And dividends, they give you a line of sight into future income. Stock prices, they wiggle up and down. Your plan, it shouldn't wiggle. So let's dive into the 3 ways to win with dividend investing. Let's start with number 1. Number 1 is very simple. Everyone will understand it, and that is that the stock price goes up. And this happens when the market recognizes the health of a business and the fact that that business is profitable and growing and all this sort of thing. And so everyone goes in to buy it and the stock price goes up. Now, the problem with relying on stock price going up is that no one knows when that's going to happen. And conversely, no one knows when the stock price is going to decline. Luckily, we don't have to predict when the stock price is going to go up or down, because we have 2 other ways to win. And let's get into number 2. Number 2 is that the dividend payment increases. And just to give you an example, let's say there's a stock that's paying $1 a share, and they decide, based on their business being healthy and so forth, that they want to pay their shareholders $1.25 a share. Fantastic, because if you happen to own that stock, you just got a 25% raise. Now, the third way to win with dividend investing is if the price declines. And I'm putting 2 asterisks here because in order for this to work, one has to be involved in what's called a DRIP program. DRIP means Dividend Reinvestment Program. And what that means is you're taking all of the income, all the dividend income that you receive, and just simply buying more shares of the same company. And that way you're just building more and more shares into your portfolio. Now, I understand that maybe this feels a little backwards, and so I'm going to walk through the math here in just a moment. Okay, so let's walk through a dividend reinvestment program using really simple math and using a fictional company to do this example. Now, let's call the company Acme. This is, again, totally fictional company. And let's say that the company is trading at $10 a share on the stock market, and they're paying out $1 a share in annual dividends. We take $1,000, and that'll be 100 shares. So year one, that 100 shares equals $100 in dividends. And because we're in a DRIP program, they're going to buy 10 shares. And that's going to equal 110 shares. Year two, that 110 shares is going to create $110 in dividends. Now here's the deal though. Year two, the stock market goes through like a 2008 crash. Everybody's panicking, and all the prices in the market go down. Nothing is wrong with Acme. Acme's business is totally fine. It's just market pressure pushing the price down. And let's say the price goes down to $5, just keeping the math easy. So remember, we have the DRIP program. What does that mean? That means that this $110 is going to buy a bunch of shares at $5 a share. So that's 22 shares. And that's going to equal 132 shares. And then so year three, that 132 shares is going to create $132 in dividends. And let's say that the market recovered, the panic has subsided, and Acme has come back up to $10 a share. We got the DRIP program. So that's going to buy only 13 shares now. And that's going to be 145 shares after that purchase. Now, what's the result? This 145 shares is going to be $145 in dividend income. And since we have 145 shares at $10 a share, what is the total account value? Total account value is $1,450. So what has happened? We've started with 100 shares producing $100 in dividends. Price goes down and recovers. We now have 145 shares producing $145 in dividends. We also started with $1,000 account value that is now $1,450. And this all happened without adding any additional money. Now, the key point here with dividend reinvestment programs is that when prices dip, it allows you to buy more shares, which allows you increased income. What this is what they call a dividend snowball. Okay, so let's tie this all together. A dividend is money that you receive simply by owning part of a company. Dividends are announced in advance so that you can plan on the income rather than trying to guess what's going to happen with the stock price. And finally, you can win three ways. First is stock price increase. Second is dividend payout increase. Third is using a dividend reinvestment program to take advantage of dips in the price to buy more shares to increase future dividend income. And now you know why I like to call dividend investing 3D chess versus the buy low and sell high strategy is checkers. With checkers investing, you're just hoping and praying that you'll be able to time the market for when the price goes from low to high and you sell at the right point. Whereas with 3D chess, you're building an income machine that just keeps going and going and going. Now let's connect the 3 ways to win framework directly to retirement. In retirement, we usually do one of two things with dividends. Before we retire or early in retirement, we often reinvest dividends to grow the income stream, which is building the snowball. Once we're in retirement, we start taking more of the dividends in cash to fund your lifestyle. And this way, you're not forced to sell as many shares, if any at all, when the market drops. The whole point is to shift your focus from, will the market be up 20% again this year, to, is my portfolio designed to keep sending me paychecks through good and bad years? Now, what about annuities? In our practice, we don't build everything around annuities. Our core is that dividend investing and building a rising income stream from quality companies. But for some people, it makes sense to add that extra layer of security using fixed annuities. And here's how we think about it. First, we figure out your essential monthly number, the amount you need each month to live comfortably. Next, we add your predictable income, Social Security, any pensions, maybe some rental income. And if there's a gap and you're the type of person who says, I want my basic bills covered no matter what the market does, then we can look at using a fixed annuity with a portion of your assets to help close that gap. That way your essential expenses can be anchored by Social Security, pensions, and optionally that annuity income. Your dividend portfolio sits on top as the main engine for additional income and long-term growth, not your only life raft. So annuities are not the star of the show. They're a tool for people who want more certainty layered on top of that dividend-focused strategy. Now, if you're approaching retirement or you're already in retirement and you have at least $250,000 saved, and you're looking at this market thinking, I can't afford to guess wrong with my retirement income, here are 2 next steps. You can watch my free retirement masterclass link below, and I go deeper into Social Security timing, income strategies, taxes, and estate planning. Or if you want personal help, there's another link below to schedule a retirement income strategy session with me. And in that session, we'll stress test your current plan against major market drops, look at how a dividend-first approach might change your retirement paycheck, and we'll talk about whether adding an annuity layer for extra security makes sense for your unique situation. Now, if this was helpful, hit like, subscribe, and share it with a friend who might also be worried about where this market might go next. Finally, a disclaimer. This video is for education and entertainment purposes only. This is not financial advice. This is not legal advice. This is not tax advice. Please consult a licensed professional, such as myself, before making any significant financial decisions.